So, picture this for a second. How is it even possible that a massive, iconic global brand, we're talking the company behind household names like Johnny Walker and Guinness, can see a staggering 17% growth in Africa, yet somehow still manage to lose billions in overall global sales? It's a completely fascinating contradiction, and it's exactly the puzzle we're going to solve today.
Welcome to today's Explainer. Today, we're unpacking what I like to call Diageo's dilemma. We're looking at an absolutely critical transition point for this FTSE 100 spirits giant, because right now, the company is operating what honestly feels like a deeply divided empire, and they're being forced to take some incredibly drastic measures just to get their house back in order. Okay, let's dive right into this. Here's our roadmap for today. First, a tale of two markets. Second, the North American hangover. Third, enter drastic Dave Lewis. Fourth, divesting and accelerating savings. And finally, number 5, what investors should watch.
All right, part 1, a tale of two markets, regional extremes. Let's get into it. If you were to only look at certain parts of the globe right now, you would absolutely think this company is thriving. I mean, Africa is up 17.1% in organic growth. Latin America and the Caribbean, up 16.2%. And even Europe is showing really strong momentum, up 8.8%. Now, to be fair, those incredible gains were partly aided by the timing of Easter, plus some advanced sales ahead of the World Cup, but still, great numbers. However, all of that is completely overshadowed by a high single-digit decline in North America, which is being driven by this continued stubborn weakness in U.S. spirits. Add to that a really soft market for Chinese white spirits, which is pulling Asia-Pacific down by 0.8%, and you can see that Diageo is essentially fighting a massive uphill battle on two of its most important fronts.
Which brings us to part 2, the North American hangover, financial realities. We really have to look at the hard data to understand exactly why weakness in just one or two regions is hitting the entire company so incredibly hard. So despite those booming sales elsewhere, reported net sales for the first half of fiscal 2026 actually dropped by 4%. That brings them down to $10.46 billion. Operating profit also took a hit, slipping 1.2% to roughly $3.1 billion. And basic earnings per share before exceptional items dropped 2.5% down to 95.3 cents. Basically, the drag from North America and China is simply too heavy for the rest of the world to carry right now.
But you know what the real ticking clock is here? $21.7 billion. Yep, that is the massive net debt sitting heavily on Diageo's balance sheet as of December 31st, 2025. When your core markets are shrinking and your debt is sitting that high, well, you have to find a solution, and you have to find it fast.
And that severe financial pressure, it totally forced the board's hand. To retain cash and claw back some financial flexibility, they actually took the drastic step of rebasing the interim dividend way down to just 20 cents per share. Going forward, they're targeting a 30 to 50% payout policy with a minimum floor of 50 cents per year. For a company that is historically known for prioritizing and really rewarding its shareholders, this is a glaring neon signal that they are in full-on defense mode. Moving on to part 3. Enter drastic Dave Lewis, leadership and cuts. So who do you call when a sprawling global empire needs reining in and totally reshaping? You bring in the turnaround specialist. Enter CEO Sir Dave Lewis, who is actually often known in the industry as Drastic Dave. But you know, turnarounds aren't just spreadsheet exercises. There's a very real human element to all of this. According to insiders, this restructuring has been absolutely brutal. One anonymous source even stated, the scale of cuts has shocked employees and shaken morale. That really sets the stage for just how deep the knife is going in order to save the bottom line. And they are aggressively targeting the top. A group of about 100 senior leaders is expected to shrink by 20 to 30%. On top of that, in one particular large regional business unit, up to 30% of the entire staff is being cut. Gone. Lewis is quite literally trimming the fat at the absolute highest levels of the organization. The cost-cutting mandates he's handed down are frankly staggering. Lewis has ordered overhead reductions of up to 40% in regional markets. And get this, an incredible 50% reduction in centralized global units. Managers right now are just scrambling. They're trying to find office closures and get creative with cost reductions just to limit the job losses, while still somehow hitting these aggressive margin improvement targets. Okay, part 4, divesting and accelerating savings, the turnaround cocktail. Because cutting jobs, that's really only half the battle.
Diageo is proactively moving assets and totally restructuring its strategy to mix the ultimate turnaround cocktail. First up, through their Accelerate program, they're targeting $300 million in savings by the end of fiscal 26. They're doing this by improving supply chain agility and marketing efficiencies. Second, they're shedding non-core assets. They recently announced the sale of East African breweries to the Asahi Group for an estimated $2.3 billion, which, by the way, implies a very healthy 17 times EBITDA multiple. And finally, their Indian subsidiary is in the advanced stages of a strategic review to actually sell off the Royal Challengers Bengaluru cricket team. They are literally raising cash wherever they possibly can. And to ensure this strategy is executed perfectly, there's a reported hunt currently underway for board reinforcements. Word is, Diageo is looking for heavyweights with deep drinks industry operating experience. Bringing in seasoned sector experts is a pretty classic move. It's designed to reassure nervous investors that the board has the right specific knowledge to both challenge and support management through this crisis. Now, despite all of this internal chaos, their fiscal 26 guidance actually remains cautious but steady. They are expecting organic net sales to be down 2 to 3%. Operating profit, that's expected to be flat or maybe up in the low single digits, largely thanks to those $300 million in cost savings we just talked about. Free cash flow is holding steady at $3 billion, and capital expenditure will sit at the lower end of their $1.2 to $1.3 billion range. Let's wrap things up with part 5. What investors should watch. The road ahead. If you really want to know if this massive turnaround is actually going to work, you need to keep your eyes on a few key catalysts. In the second half of calendar year 2026, that $2.3 billion EBAL sales should officially complete, which will immediately help reduce that massive debt leverage we saw earlier. Then, in early fiscal 27, they've got a new SAP S/4HANA software implementation coming up. Now, that requires a $100 million one-off inventory build just to make sure operations run smoothly during the switch. But hands down, the most crucial date on the calendar right now is August 6, 2026. That's when Drastic Dave Lewis will present his highly anticipated strategy update alongside the full-year results. That is going to be the absolute ultimate test of investor confidence.
But of course, the road is paved with risks. The absolute primary risk remains that ongoing U.S. spirits weakness. I mean, if North America doesn't stabilize, no amount of aggressive cost-cutting is going to save their profit margins. They also face continued softness in the Chinese white spirits market, unpredictable geopolitical and tariff tensions that could really impact supply chains, and finally, just the sheer execution risk of it all. Turning around a ship this incredibly large, while simultaneously slashing headcount by up to 30% in some divisions, leaves a whole lot of room for error.
Which leaves us with the ultimate question today. Can Drastic Dave mix the perfect turnaround cocktail, shedding those assets and ruthlessly cutting costs to rebuild a leaner, stronger company? Or is the North American hangover simply too strong to shake off? It is a phenomenally high-stakes transition for one of the world's largest consumer brands, and all eyes will definitely be on that strategy revealed this coming August. Keep learning, keep watching the data, and we will see you on the next Explainer.